Hi there, Robert Wolf here with Terra Firma Business and Financial Consultants. Welcome back. So this video is going to talk about just the individual membership, and what more specifically we're going to look at is the risk tolerance assessment that we offer, as well as the financial organization, the website that offers the financial organization. So let's go ahead and dive into here. Once again, the employee membership's $97 a month, and here's all the things that are offered with it. I know you saw the other video that talks about this information. If you did not, I apologize, but I want to get more focused on the risk tolerance assessment and the financial organization. So you can go back to the other video and see more of an explanation of the employee as well as the business membership and what the differences are. And here's our credit card form that you probably received. So with your risk assessment plan, you're going to receive an email from us once you sign up. And in the email, you're going to get a link. You click on the link, and these are basically the 3 questions that pop up initially. What are your financial goals? So you click on what your financial goals are, whichever ones those are. You hit next. It says, okay, let's talk about retirement. And because you clicked on retirement, they ask what date you were born, what year, what's your age of retirement. You click next. If you're already retired, then obviously retirement may not be your top priority. Maybe income is more your priority, or accumulation, or paying down debt. Okay, so if you're already retired, we can talk about that. But if you're looking, or you're working part-time, or you have a business, you own a business and you're of retirement age and you're not really looking to retirement, but you're still concerned about that saving for the future, go ahead and click it. It's not going to hurt. We'll fine-tune it when we have a conversation. So once you put the year birth, the year you're going to retire, you click next, and then it's going to ask how much you have to you already have to invest. So if say you already have $1 million, you put that in there and you click next. Okay, so then it's going to talk about how much risk can you handle in a 6-month period. So let's say I want 11% rate of return. So if I start with $100,000, 11% rate of return, or a 11% rate of return here, this is where our 6-month range is. Okay, you can just move and slide this scale here. So if you want a higher rate of return, you slide the scale. The risk and the reward will both shift as you slide along here. You find what you want, you hit next. Now it's going to say, what if you could improve on that? Meaning, here's your original choice in the middle. What if you want less risk? So you want 7% risk instead of 11%, but you want the same reward. Are you concerned? Are you interested in that? Click yes. The opposite is true. Let's say you're comfortable with 11%, but you want a greater reward and closer to 17. You click on the right one. Okay, one or the other, all right? And you hit, once you click on that, then it's going to pop up, okay, how about now? So your last choice was you want more reward. You're comfortable with 11% risk. You want more reward. How about would you like even more reward, but your risk would bump up a little bit? Okay, you choose whichever one you want, and when you click on that, you click next. And this is what happens. A risk assessment plan pops up your risk number. So in this situation, you're risk 59 out of 100. What that's saying is I'm comfortable with a 19% rate of return and a 12% potential loss. Does that feel like you? You click yes. If it doesn't, click back and go fine tune it. Once you fine tune it, it'll pop up your risk number. It'll summarize here. If that feels like you, click yes. Then you're gonna get a little window that pops up, says, "Hey, thanks," and it's gonna put your name. In this case, it was Test, and it's your responses went back to me, and then I'm gonna get your responses. Okay, then what's going to happen is that we're going to take a look at your situation. Here's a sample client. Their risk was 37. They were comfortable with a 10% rate of return or a 6% loss. They had quite a bit of assets, of 1.4 million. So let's take a look at it. So they had one of their accounts. They had a risk of 73. But this is how it was segmented. So they had some Johnson & Johnson, Growth, Northrop Grumman, so a lot of individual stocks. This particular clients were in their late 60s, early 70s, so a 73% risk. They really didn't have a whole lot of focus on what their plan and what their strategy was. The reason being is that look at all the other stocks. Okay, but then they had a Merrill Lynch real estate account. Well, what did that mean? Well, it just meant that they had more individual stocks. They had some ETFs, some mutual funds, but they had about 41% of their assets in here, whereas in cash. So their risk here was 31. That's because 41% of their, we find a lot of times that some planners, when they do a lot of individual stocks, the way they reduce risk is use cash. We have a different philosophy and a different strategy with that we'll go over with you when we present our findings and our ideas. And so they had other accounts. Wells Fargo, they had $400,000 in. They had a John Hancock annuity. They had a couple annuities or IRAs with State Farm. So they had a total of 1.4. So it's kind of all over the board. 74 risk, 74 risk, 74 risk. Obviously, cash is 1. So they kind of were all over the board. But then what we do is we take that and we say, okay, your current risk plan versus what the S&P 500 was like. So we'll go through this stress test with the way current markets have done. So the bull of 2013, the bear market in 2008, the financial crisis from 2007 to 2009, and then if interest rates kept going up, how would that perform? And so we can see where our assessment is based on that. Okay, and then we can create a similar portfolio. So in our proposed portfolio, we still had a risk level of 37, but take a look. The risk was at 6 still, but we were able to get them about 3% more, 3.5% more based on our strategy and what we were able to do. And so again, we stress test that. This is where they were at. Here's where we're at. So we in a bull market in 2013, we get them 14% higher rate of return. Now we were taking the same amount of risk, but because of the type of strategy, we were going to take a little more loss and a little more risk. So in this conversation, we have to focus on this. If this were to occur, are you okay with this? If they're not, then we have to adjust it, which is not a big deal. That's the point of this process and why we go through this. We want to make sure that you're comfortable with it because this is your money. Bottom line, though, they were already taking too much risk, as 74 was their current one. They were already taking too much risk based on what they're trying to accomplish. Okay, so now let's look at the financial website. So what happens with the financial website is you're going to get a link from us, and in that link you click on it, and this is the first page that pops up. It says let's get started, so you click let's get started. Some of this may be redundant to what you did with the risk assessment. I apologize for that. There is a way for us to consolidate that, but we're not going to go through that in this video. This is a sample client, not a real client. This is a sample client. They have a high net worth. They have some investments. They have a business in here as well. So let's kind of go through some of this. This is what their dashboard looks like. Their risk number was a 42, and our portfolio is a 35. So we're taking a little less risk than what they're comfortable with. So we have some leeway and some adjustments to do there. And here's their asset allocation based on their actual investments. The 2.7 million is right here. And then other assets, their 401k, the mutual funds, list is down here, as well as emergency fund, Catherine's 401k plan, and a whole life policy for Charles. The emergency fund of $100,000, we have a different philosophy with regards to emergency funds and rainy day funds. So we'll go through that with you as through the planning process. We're not going to talk about it right now. So when you take a look at it, you can see right here from their site the list of their accounts. So their cash account, you click on this add account, and there's a training on how to do this. How to set up an account. We just want to show you kind of an overview. So all your accounts are here: credit cards, investments, and assets. Summarizes your net worth, your investments, where your goals are. So Adam and Morgan's college are fully funded, but the retirement is not. So they're 2 of the 3 goals they've hit. So now we know what to focus on. Because it's a test client, it doesn't show anything on spending. Once we upload your credit cards and your checking accounts, then what'll happen is that it'll show your spending live time, so in real time. So when we do the monthly, quarterly, and annual reporting of financial statements, this will all be included, and it'll be all segmented based on how it's allocated in this plan. Protection and insurance. Right now we only have term and a whole life policy in here. We can actually add other protections in here as well, whether it's auto insurance, homeowners, whatever. Now when you click on organize, it kind of goes through and you can add some additional personal information. You can add people. Again, we have a whole training on this, so I'm not going to go through this specifically, but you can have everybody that's involved, kids, grandkids, anybody else that's involved, and all property. This is what's important. They have their cars, a beach house, they have their business, home, and some other property and jewelry. So it kind of really tracks everything. Tracks your goals. Remember, we talked about their goals. They got 2 of the 3. It talks about, we can click on spending, but because there's no spending, we're not going to show anything. Click on investments, and we can break down each of these. You click on anything that's hyperlinked, and it opens up that account and everything that shows allocated with that particular account. And this is just a summary. So in this case, we clicked on it and click on allocation, and it shows all the allocations, percentages, and stuff based on your risk number. So we can have a good idea of where we're at. The other thing is that we really like about this, and what we really want to help do is on the organization side, they have what's called a vault, and it's a shared document. We can put all your documents in here. The reason why we want to put all your documents in here is because we can give access. So let's say your tax returns are in here. We can give your CPA access to the tax returns. We can put insurance documents, so you have auto and home owners insurance, and we can give your personal lines insurance agent access to those policies. If these guys are business owners, so we can put their business policies in here, their corporate, any trust documents, basically any document that is of value that needs to be put away, we can put in this vault and have it shared. So any trustees or co-trustees to a trust, a business partner with regards to articles of the documentation. So we can really organize this however we want. So we'll help you through that and walk you through that, and that's what we would do. So this gives you an idea of what you get from the financial organization and the risk assessment. So thank you very much for your time. Have a great day. Bye-bye.